Hello everyone, welcome to Rajeshwari's Commerce and Management Study Hub. I am Rajeshwari here. In the previous videos, we have discussed about the house property theory part. Now let us solve the problems under house property. Income from house property. This is the second head under the income tax. First head salary, we have discussed the problems already. If you have not watched the video, watch the previous videos. Calculate gross annual value of Mr. Ajay from the following particulars given below. Annual rent 1 lakh per annum, municipal rental value 65,000, fair rental value 69,000, standard rent 55,000. The assessee could not realize rent for 1 month and house also remained vacant for 3 months during the previous year. So in this question they are given MRV, FRV and standard rent, and there is information related to the vacant of the house. Let us calculate. First you have to compare the municipal rental value, that is MRV rental value you are comparing with the FRV, fair rental value. That is fair rental value. Fair rental value is 69,000. Now in this, by comparing these two, whichever is higher you are going to consider. Municipal rental value is 65,000, fair rental value is 69,000. Whichever is higher we are considering. That we are comparing with the standard rent. Okay. So which is the higher? 69,000, whichever is higher. 69,000 is the higher one that we are considering.
Then with this whichever higher amount we are comparing the standard rent. Standard rent is how much? It is given. That is standard rent is 55,000. Now you are comparing these two. It is whichever is higher amount, and the standard rent we are taking the whichever is lower. Whichever is lower. 55,000 is the lower, so that will be considered. Whichever is lower. Now with this we are comparing the actual rent. Actual rent. Actual rent is, it is given 1 lakh, right? 1 lakh is the actual rent divided by 12 months, because we have vacancy period that we have to minus. Okay, so 1 lakh divided by 12, what is the rent per month is? Rent per month is, it is 8,333, because 1 month rent is unrealized, it is so not able to realize that 1 month rent you are minusing 8,333. Then we will get 91,667 is, then from this amount this will be whichever is by comparing these two, whichever is higher we are considering. Which is the higher one? 91,667 is the higher amount. Now with this, from this amount you have to minus the vacancy period, less vacancy period. Vacancy period is 3 months. The house was vacant, right? What is the rent per month? 8,333. How we got 8,333? That by dividing total rent from the month, 12 months. 8,333 into 3 months it was vacant. Into 3 will get 24,999. Now our gross annual value is, gross annual value GAV is 66,668. Understood? Yes. First what we are comparing? Municipal rental value, fair rental value, whichever is higher. Then with that amount standard rent we are comparing, whichever is lower will be considered. From that actual rent. Actual rent, any unrealized rent is there, that you have to minus, not the vacancy period. Unrealized rent. Here 1 month is not realized. That is why this 1 month we are minusing. That is 91,667. Then whichever is higher we are considering. Then from that amount if we minus vacancy period, then we will get gross annual value. Okay. Yes. We'll solve next question. Calculate gross annual value of Mr. Raj from the particulars given below. Municipal rental value is 1,60,000, fair rental value 1,80,000, standard rent 1,75,000, actual rent 1,68,000, unrealized rent of previous year 42,000, and vacancy period is 1 month. So here unrealized rent is also given, vacancy period is also given. Let us calculate now. Okay, so first what we are considering? Municipal rental value. Municipal rental value is 1,60,000. With this you are comparing fair rental value. Fair rental value is 1,80,000. Comparing these two, whichever is higher will be considered. First, whichever is higher. Which is the higher one? 1,80,000. Then we are comparing standard rent. Standard rent is 1,75,000. 1,75,000. Now comparing these two, whichever is lower will be considered. Which is the lower one? 1,75,000. 1,75,000. This will be your expected rent. It is also called as expected rent. Expected rent. Then we are comparing the actual rent. Actual rent is how much? Actual rent is 1,68,000, but we have unrealized rent 42,000. From actual rent 1,68,000 minus 42,000 will get 1,26,000. Now whichever is higher will be considered. Whichever is higher. 1,75,000 is the higher one. Now we are comparing, we are deducting the vacancy period. Less vacancy period. Vacancy period is how many months? Vacancy period 1 month. What is the total rent? 1,68,000 divided by 12. So 14,000 is the 1 month rent. If we minus this, we'll get gross annual value. 1,75,000 minus 14,000, 1,61,000. Understood? Here municipal rental value, fair rental value, whichever is higher. Then we are comparing with standard rent. Then expected rent, whichever is lower amount is your expected rent. With expected rent you are comparing actual rent. Actual rent, if any case of any unrealized rent is there, that should be deducted. Then we'll get 1,26,000. Higher amount is 1,75,000. Then from that amount, if we minus vacancy period, we'll get gross annual value. Okay, we'll go to next question. Determine the net annual value of the house property for the assessment year 2024-25. Municipal rental value 1,50,000, fair rental value 1,70,000, standard rent 1,30,000, actual rent per month 15,000, unrealized rent 18,000, house vacancy period 1 month, municipal tax pay rupees 15,000. So one extra item here we have, that is municipal taxes given. So let us solve this question. First we have to take it municipal rental value, that is 1,50,000. From that we are comparing fair rental value, that is 1,70,000. Whichever is higher. What is the higher amount? 1,70,000. Now standard rent we are comparing. Standard rent is 1,30,000. Now we are considering whichever is lower, that is 1,30,000 is we are considering. Then with this we are comparing actual rent, but we have actual rent 1,80,000 minus unrealized rent is there, that is 80,000. 18,000 you have to minus 1,80,000 minus 18,000 is 1,62,000. Now whichever is higher, 1,62,000 is the higher. From this we have to minus vacancy period less vacancy period. Vacancy means vacant house was there was no tenant in that period, that is called as vacancy period. Vacancy period is given 1 month, right? Here monthly rent is given, that is 15,000 per month. That only you have to take it. So your gross annual value 1,62,000 minus 15,000 is 1,47,000. Then we will get tax. One extra item tax is there. After getting gross annual value, from that you have to minus municipal tax. Municipal tax. Tax is 15,000 given in the question. Municipal tax is 15,000. Then we will get net annual value, NAV. From gross annual value, if you minus tax, you will get net annual value. Net annual value is 1,32,000. Next question. Determine the annual value of Mr. Sham, resident, in the following cases. Here we have expected rent. He owns 3 houses. House 1, house 2, house 3. Municipal value 72, 72, 72. Standard rent 80, 90, 78. Actual rent received or receivable 1,20,000, 1,44,000, 1,80,000. Property is let out throughout the previous year. Unrealized rent is given. Local tax borne and paid by the owner in the previous year is given. Let us solve this question. Here we have 3 different houses of the owner, right? When all the houses are vacant and they have given for the rent. Let us solve. First we have to take it municipal rental value. Municipal rental value of house 1 is 72,000. 72,000. Then with this comparing fair rental value. Fair rental value is 84,000. 84,000. 84,000. Now whichever is higher you are considering. Whichever is higher. Which is the higher one? 84. 84. 84. Now you are comparing the whichever is higher with the standard rent. Standard rent is 80,000, 90,000, 78,000. Whichever is lower. Which is the lower one? 80, 84, 78. 80, 84, 78 is the lower. This will be your expected rent. Now from expected rent you have to minus actual rent. Actual rent and unrealized rent is given. Actual rent is 1,20,000 minus 30,000, 90. Then we have 1,44,000 minus 72 1,80,000 minus 72 1,08,000. Now whichever is higher is your gross annual value. Higher gross annual value 90, 84, 1,08,000. Now from this amount we have to minus tax to get the NAV, net annual value, less tax. Tax is also given, that is 6,000, 12,000, 18,000. 90,000 minus 6,000, 84,000. 84,000 minus 12,000, 72,000. 1,08,000 minus 18,000 is 90,000. This is the after minusing the tax net annual value when three different houses of same resident is given. Let us solve next question. Mr. Shashank is the owner of the three houses, the particulars of which given below. Fair rental value 90,000, house rent let out 10,000 per month, municipal tax paid by Shashank 10,000, 10% of municipal value. Determine the annual value of the house if the house was vacant for 1 month, 2 months. Here we have to calculate two different cases. When the house is vacant for 1 month and house is vacant for 2 months, this you have to calculate in the two different lines. This is the homework question. You have to solve this and send it in the comment box. What is the answer for this question? Okay. Then next, calculate the allowable interest on loan from NAV of the house property. Date of borrowing loan 1st June 2016. Date of repayment of loan 10/5/2024. Date of completion of construction May 2024. Amount of loan borrowed rupees 30,000. Interest on loan 20 per annum. Let us calculate the here post construction and pre construction this interest we have to calculate. First, pre construction interest. Pre construction interest for the period of 1st June 2016 to 5th, that is May 2021. It is 21. Completion, date of completion, pre-construction period from starting to till end of the completion of the construction. Here date of completion is given, that is May 2021 it is. Okay, completed. Now from 1st June 2016 to 31st March 2017. What is the amount of loan borrowed? That is 30,000. Rate of interest on the loan is 20 into for 10 months divided by 100 into 12 months. So what is the amount of interest we are going to get? 30,000 is the amount of loan borrowed. 20% is rate of interest. 10 months is from period from 1st June to 31st March for this academic year. Right, this is assessment year. What is this? 5,000. Then 1st April 2017 to 31st March 2018. The accounting period 30,000 into 20% by 100, 6,000. Then next, from 1st April 2018 to 31st March 2019, till the completion of the construction, you have to calculate 30,000 into 20% is 6,000, right? Then next, from 1st April 2019 to 31st March 2020, 30,000 into 20 by 100 is 6,000. Then 1st April 2020 to 31st March 2021, that is 30,000 into 20 by 100. What is the amount? 6,000. Now what is the total interest? Because first May completed, so till the March 2021 we are considering. So the total interest is 29,000. Now calculation of pre-construction period interest. Total interest divided by number of years of in equal installment. Total interest divided by number of years, that is equal installment. How many years? Total interest we calculated, that is 29,000, and that was for how many years? 5 years. See, 1 2 3 4 5. In 5 equal installments you are paying. Equal installment, what is the amount? 5,800 is the interest amount. Calculation of, then next we have to calculate calculation of interest for the previous year, that is from 1st March 2023 to 31st March 2024. So what is the interest? 30,000 is the amount into 20%. So it is 6,000. Then total interest for the previous year. Total interest for the previous year, pre-construction period interest plus current previous year interest. Installment 5,800 plus 6,000. Total interest is 11,800. I hope you all understood how we calculated. First we calculated for the pre-construction period. From the loan taken date to till the date of completion we have calculated interest, that is pre-construction interest, and divided into equal installments, that is based on number of years. Then 5,800 for the previous year we have calculated interest, then we have added both the interest, total interest for the previous year. Yes, we'll go to next question. Calculate the allowable interest on or loan from net annual value of the house property. Date of borrowing loan 15th June 2017. Date of repayment of loan 31st December 2021. Date of completion of construction 31st May 2022. Amount of loan borrowed 40,000. Interest of loan is 15% per annum. This also you have to take it for the homework and you need to solve this question. You need to comment section what is the total interest amount. Next question. Mr. Mukesh is the owner of the houses in Bangalore. Particulars: fair rental value, house A, house B, house C. 3 houses are given. Municipal valuation is given. Let out per month rent is given. Used by tenant. One house is used for residential purpose. Residential, office, residential. Construction started 13 May 2017, 1st Jan 2017, 2nd March 2013. Construction completed 1st April 20, 1st June 20, 31st March 14. Repair expenses, collection charges, interest on loan for construction, for marriage daughter, for repair is given. Municipal tax is 10% of municipal valuation. Municipal tax of the house A was paid by the owner, but municipal tax of house B was not paid up to 31st March 2021. Municipal tax of house C paid by the tenant. The house C was remained vacant for 2 months. Compute income from house property for the assessment year 2024-25. I hope you all understood the question. First you have to analyze the question. Half of your answer will be there in the question only. If you don't know, if you are not analyzing the questions, then you will not understand the answers. Don't by head, just understand the concept and why you are writing, when you are writing, that you have to understand. So let us solve this question now. Here we have 3 different houses and all the 3 houses used for residential, office, residential, not self-occupied. If it is self-occupied, then we are not calculating. Because it is not self-occupied, we are calculating for all the 3 houses. Particulars A, B, C. First we are taking municipal rental value. Municipal rental value for house A 15,000, 20,000 and 10,000. Fair rental value, these two we are comparing and whichever is higher we are considering. 18,000, 15,000, then 12,000. Whichever is higher. Higher is 18,000, 20,000, 12,000. Standard rent. Standard rent is not given in the question, so it is nil. The same amount, your expected rent, whichever is lower, same amount you are going to consider for the expected rent. 18,000, 20,000, 12,000. Now actual rent. Actual rent is given. For house A it is 2,000. For 12 months it is 24,000. 1,500. For 12 months it is 18,000. Then 2,500 for 12 months it is 30,000. Now we are taking whichever is higher. Whichever is higher is 24,000, 20,000, 30,000. Okay. Then next less vacancy period. It is not unrealized rent is not given, only vacancy period is given. So vacancy period is only for house C it is given, that is 5,000. your gross annual value 24,000, 20,000, 25,000. Now less municipal tax. Municipal tax only for house A it is paid by whom? Municipal tax is 10% of municipal valuation. For house A it was paid. On municipal valuation is 15,000. On 15,000 10% you have to calculate. Only for house A it is 1,500. House B, house C it is not there. Net annual value net annual value is 24,000 minus 1,500 is 22,500, 20,000, 25,000. Now we have standard deduction under section 24. Deductions comes for the house property from 24. Deductions under section 24. First one we have 30% of NAV. 30% of NAV, net annual value. On net annual value you have to calculate 30%. That is 6,750. On 22,500 into 30%, 6,000, 7,500. Then interest we have for construction. It is 10,000. For daughter marriage and all that we are not considering. Only for the repairs that we are considering. For repairs it is 1,000 for house C. Now this is our income from house property. That is after minusing 5,750, 14,000. This is 16,500. So what is extra we have done? First we have calculated GAV. From that we have minused the municipal tax. If it is paid by the owner, then we are minusing. Then we will get net annual value. From that we have deductions under section 24. First one is 30% off on net annual value you are going to take. Then for construction of repairs, any loans if you have borrowed, that one you are taking interest. For repairs, whatever loan you have borrowed, that will be considered 1,000. So after minusing the deductions, we will get income from house property. For house A, it is 5,750, B 14,000, C 16,500. I hope you all understood. Thank you for watching. Have a great day.